Hello everyone. Good evening. I am CA Hiten Bimjani and I welcome everyone to webinar series 34, Role of Risk Control Metrics in Strengthening Internal Audit Process and Internal Financial Controls, Best Practices and Key Benefits, organized by Board of Internal Audit and Management Accounting, ICAI. So friends, we keep hearing about risk control metrics, that it is very important in effective internal audit. It helps to map controls with risk, decides authority, etc. But many people will have a lot of questions. So in today's session, we will understand from our esteemed speaker all about the risk control metrics. So without taking any much time, I'll quickly introduce our speaker, CA Pratik Goyal. So CA Pratik Goyal is a qualified fellow chartered accountant. He has completed DISA, FAFD, MCOM and BCom. CA Pratik Goyal is partner at Kirtane and Pandit Chartered Accountants. He heads North India Risk Assurance Practice. He has experience of more than 10 years in internal audit and risk assurance services, and he is based out of New Delhi. Before joining Kirtana and Pandit, he was partner at PGSJ and Company Chartered Accountant for 4 years. Pratik has worked in the risk assurance services of PwC and Axis Risk Consulting. During his articleship, he has worked with Ray and Ray Chartered Accountants and BACS Yamuna Power Limited in internal audit department. He specializes in the area of risk management, internal audit, process review, and designing standard operating procedures, internal control over financial reporting, forensic audit, information technology audit, concurrent audit, etc. He has experience of working with various industries like power transmission and distribution, real estate, NBFC, construction, energy, oil and gas, NGO, hotel, manufacturing, IT, passive infrastructure, etc. With this vast experience, I am sure CA Pratik Goyal will add a lot of value and give insights of the practical aspects of risk control metrics. I welcome CA Pratik Goyal and I hand over to him.
Thanks, Hiten. Thanks for giving a brief introduction. And thank you, everyone, for coming across and joining this seminar. In this seminar, it will be a structured seminar in which we'll be covering few of the topics. First of all, we'll be taking care of what is the risk and the risk management techniques which is followed by various companies. Secondly, we take care of the internal IFC, internal financial control, its applicability and its process, how we'll do the IFC. Third thing, we'll take care of the internal audit and how internal audit and how it is impacted by the RCM. And fourth area, which is a more main crux area, which we'll take care is the RCM, which is risk control metrics, and how that risk control metrics play an important role in strengthening the whole process of IFC and internal audit. So at last, in the last we'll do some we'll go through some of the RCMs of various organizations. Yeah. It's cracking. Let me check. Is it better now? Yes. So just let me present my screen. Yes. So Hiten has given already given you a brief background about myself and my journey is till now as a partner at Keaton and working in the domain of this insurance services. So frankly speaking, during my whole journey, this topic is very near and dear to me. And I have realized so much importance of a risk control metrics during the whole of my journey. Means during my articleship, I'm what is called the RCM. I've never heard about it, and once I got into the Big Four and other risk consulting companies, I got to know about this term, and it's a very useful tool, which was very helpful for me in the whole like while like this planning for the whole audit, in the planning for the internal audit, and in the execution of the internal financial controls. So it is play a very good role, very important role in the today's era. So when we talk about the current era, there is a dynamic which is very dynamic. There is a continuous changes, and there is regular need of updation, and there is like regular with the technology upgradation. There's a lot of risk which come along, and which impact the whole organization and put the company at various stakes. So we need to identify those risks, and we need to focus on this, and we need to try to mitigate that risk and identify those strategies. So for that, very important uh, process which is called the risk management. So for the understanding risk management, we need to understand the risk first. So when we talk about the risk, it as per the COSO framework. So it is a possibility that an event will occur and affect the efficiency, affect the achievement of a strategy and a business objective. So in a simpler word, we can say that potential for a negative event to impact the organization to ability to achieve its goal. So it is our risk. So anything which is going to impact our the organization in achieving its goal and objectives is risk. So there are multiple type of risks. So we can be broadly classified narrow into inherent and the residual risk. So inherent risk is present the baseline level of yes.
Hello. Am I audible now? Perfect. Yes. So we were talking about the inherent risk. So inherent risk represent the baseline of the threat of an organization before any controls are implemented. It means if a company is in a raw form and though no controls has been implemented, company inherent some risk from various processes, and each process have its own risk associated with it. So it inherent it, and once we apply some controls on it, we have still there's some risk which is called the residual risk. So residual risk reflect the level of risk that remain after the control has been implemented. So this control can be preventive, which is like use of the strong password to prevent the cyber attack. It can be detective if we like have a regular inventory audit to identify the potential theft. So residual risk will remain even if if an organization have implemented the control, but it should be in an acceptable limit. It cannot be more than an acceptable limit. So for that, we'll cover that in the next slides. For the introduction, the risk management process, like we'll go through like what is the risk management process, then what are the type of risk, with a risk category, and how to identify and categorize our risk. In the risk management process, we firstly identify the risk, various risk which is there, which can be external, internal, can be organized in the external risk. It can be a political, geopolitical, anything like it can be a disaster, natural calamity related. It can be any type of the risk. So we identify those, then we assess those risks on the on their likelihood and their impact, and based on that, like we'll prepare a scorecard, and based on that we'll prioritize our risk. So it means we'll more prioritize on the risk which is on the higher side, which is a high risk and which can impact the organization, which is more likely to be happening. So for the detailed person, we'll cover in the next slides. So these are the various type of risk, which is called external risk. In the external, we have like demand, which is not into our control. Some regulatory risk, there can be any change in the policy of the RBI income tax. It can be a regulatory one. Then economical, so it is again any change in the acts which is not into our control is an external one. Social political, which is like change in the political party in the country, in the states, which can impact the organization, and further the environment, which is relating to natural calamities. Further, when we talk about the internal risk, it can be broadly classified as strategic, operational, and enablers. So strategic will cover the governance, which is strategic is basically related to the top management. So it is relating to they have whether they have the governance policy, they don't have governance issue, which is the corporate governance issue, then they don't have the ethics and values in place, or is not communicated to the like various process owners. Then stakeholders relationship, we are not managing it properly, we are not doesn't have a relationship management system which is not in place. So it can be strategic. Then when we talk about other risk, which is the operational one, which is we have some process which is SOP defined and process is not followed, or there's some design deficiency into the process which can be there. Then the like business interruption which can impact. So various enablers which for all this risk are the people, financial and technology and infrastructure. So which is the key enablers for our risk. When we talk about the strategic again, strategic risk which demand in the shortfall, customer retention, integration problem, pricing pressure, regulation, R&D, industry or sector turn down, JVs and partner losses. So it can be a strategic risk which is top flows from the top, which is like a strategic decision of the top management. Then we talk about the hazard risk, which is the macroeconomics, political issue, legal issues, terrorism, natural disaster is the hazard risk one. Then the financial risk, which will cover the debt and interest rates, poor financial management, asset loss, which we are not safeguarding our assets, goodwill and its amortization, and accounting problem, which is relating to financial one. And a few example of the operational risk are there's a cost overrun, operational inefficiencies there. We are not utilizing our capacity. There is a issue in the supply chain, which is there is a delivery or there is high cost of supply chain, which is there. Employee related issue, bribery and corruption. So these are the few example of the operational risk which we have in an organization. Before going forward, and we need to understand two important things. Like organization need to identify two important things, which is like what is their risk appetite and what is their risk tolerance level. There's a minor difference between the risk appetite and the risk tolerance level. Risk appetite is the company risk appetite is like company have a inherent risk, and the company is ready to accept that risk, and that is not impacting the operation of the company much, and company can easily accept it and doesn't need to take care of anything. But when we talk about our risk tolerance, various company have various type of risk tolerance level, and they can define it based on their likelihood and their impact. So from the chart which we can see here, if a company having a low risk, a low impact, and there is a low possibility of happening that event, that risk, that will be within the risk appetite of the company. If it is on a higher side, like on the contrary, if it is on the higher side, if the impact is high and the likelihood is also high, the company like is not that is not into the risk appetite of the company, and company will try to like prioritize that risk and control that risk on a priority, considering the low risk and the low impact and the low likelihood. So less risk appetite need to be we need to identify the risk appetite of the company, and company need to identify this before they start with the risk management process. So when we talk about the risk tolerance, there's an example like where we give some pointers to to identify the risk tolerance level. So in which like first is very low risk tolerance. In this, like company doesn't like it can be measured on four parameters. One is relating to the cost. Second is schedule, which is like the time involved in that process. Then the like scope, which is there, and the quality, which is there. Quality that will be impacted. So in very low, when we talk about the risk level, tolerance level, which is very low, in that case, it have an insignificant increase in the cost, and company the like have very low threshold for any of the any of the risk relating to any of the risk. The company have very low level of tolerance. So they if they even a small increase in the cost, they will start instantly, and they will accordingly take the action. So risk tolerance helps the company to identify and uh, those risks which can be avoided, or which they can accept. Means if the company have a risk tolerance level of like say 25% of increase in the cost, that doesn't impact that company. In that case, like that risk, the total risk which will register will be prepare, and we identify that this risk is within the very high category, and this company is ready to accept. But normally doesn't company doesn't impact this 25% increase in the cost. But yes, each company have different level of risk tolerance, and it need to be defined before, so that once we map all the risk related to all the process, we have a threshold criteria on which will consider that this risk need, like whether any action need to be taken or not, or whether that risk is acceptable, and we like company accept that risk and we don't take any action on that. So it is very important for a company to set their risk tolerance level, and they should know their risk appetite also once they plan for the risk management. So again, it is like we have plotted some of the examples. Like company, it can change from company to company. Company law say example, they if the company have a risk of loss of key manager position. So, if we talk about it is likelihood is high, and impact is also very high. So it is above. You can see this red line. It is the risk, risk appetite of the company. So it is above that risk appetite of the company, and this can impact the company, and this company will take the immediate action. And when we talk about this dark blue circles, they are impacting the company, and this is above their risk appetite. But still, company will prioritize firstly on this blue circle first, and then they will go relating on the other risk, considering the other risk based on their risk rating. And these two risks, which is below the risk appetite, this company can accept that risk and company will move forward. The company won't take any action on this. Or once if they have threshold is defined and threshold is below this, they will not take the action. Once they revise their threshold for the risk tolerance level, they will change this line, and this risk will go above this line. So in that case, company will take the necessary corrective action based on the priorities. Yes. So when we talk about the risk management process, it starts with risk identification, and then broadly classifying them on the basis of in the four parameters, which is first, like whether we can transfer that risk. Means like, for example, when we talk about transferring our risk, it is like when we take an insurance. It is a classic example of the risk transfer, where we transfer our risk to the insurance company, and the company is insured by this. Another example is the cash management system which the bank use, in which like they hire a cash management company who take care of all the cash uh, at various banks. They collect from there, and they have the total responsibility of if any loss or any theft in on the way. So that is the classic example of the transfer of risk. And secondly, when we talk about the terminate is means like company will identify some of the processes which is the unnecessary process and the risk associated with it, and company doesn't want to continue with that. So they can terminate that risk immediately. They can close down that process, and like that risk will be solved. So before that, for the identification, we need to classify all the risk into all the four parameters, whatever the parameter that relates. Then the company have an option to tolerate. So if the company have impact is very low and likelihood is very low, so company will tolerate that. So I've given you example that I've told you that company will accept those risks if it is before the threshold or of their risk tolerance, and if it is below their risk appetite, so they will tolerate that risk and they will accept it. For example, company has given some money to their to their peon, may say like 5,000 rupees to spend that amount for the petty expenses. So in that case, company has accepted that risk. Like there is no process for like maker checker, or there is no process for authorization, delegation of authority. So there is no requirement for approval as per the DO. So in that case, if any expenditure below that 5,000 rupees, if that peon is making, the company is not taking much care about that, because company has accepted that risk. So they have not put that control into that system, and they tolerate that risk. So don't they take any action on that. But when we talk about the risks which have the low impact, but a likelihood is high, which is day-to-day activities, there can be a human error, or there can be error in the process which they follow. So the company need want to treat those risks, so that because likelihood is very high, it means like a company wants to the chances of impacting the organization is again on a higher side, because it will risk is high because the likelihood is very high. So in that case, company will treat those risks, and where our role as chartered accountant will come in, like where we will go for the internal audit, we go for the IFC part. So in that case, like they will otherwise they can put some controls accordingly, like so they can use various measures to trade those risks and their likelihood. Okay, so in this risk identification, we'll like prioritize and categorize all our risk, identify those them, and like mark them into the four coordinates. Right. Next step, once we identified those risks, we need to do the risk assessment. In this, like we'll give the risk rating to various risk based on their probability and their impact. So you can see here in this table. If a risk is high, their probability is high and their impact is also high, where they've given some 5 points. Here you can see impact also 5 points and the probability is all 5 points. So if both is high, we multiply those and we have a scoring point, which is risk rating, which we have. And accordingly, we'll calculate all the risk rating here and map those here. So if in this case, like you can see like one there's some risk which have low impact and low likelihood to have a rating of 1. And whereas like it if there is a likelihood and the impact is high, it is on the rating of 25. So more the rating, more the points, more the like score which we have, the more priority with the company need to take, and company need to take the action and they mitigate that risk. Uh, like prioritizing that and keeping that as the most important thing. in the company. So accordingly, like the company will go from top to bottom and see if like this low risk need to be covered or not. But right, if when we want to prioritize, we need to take the most high risk points first and then do it. So this, once we identified the risk, we do the assessment. Assessment in this assessment, we'll do the risk rating of all the risk and based on their likelihood and the like likelihood and their impact. So you can see how we have in the probability or like likelihood, how we have categorized as high. It means like major uncertainties are there. No or little prior experience or data is there of the company. Then infrastructure or resources are not in place. Means the company doesn't have infrastructure and resources in there. So probability is high in that case. For classifying that as a medium one, company have some uncertainty, like they don't have like full uncertainty, but they have some uncertainty remaining to it. So in this case, some they have some prior experience, some data in that case, they can consider it as a medium probable. And company have infrastructure, but not it is under resource, means like they don't have a proper resource, but they have the infrastructure. So likelihood that will impact the likelihood of the risk. And when we talk about the low risk, when we categorize low probability, in that case, we have there's no uncertain remains, means we have very much clarity that this is not going to happen. This risk is okay, we can accept it. And there's no uncertainty on that. And like significant experience and data exist, sufficient data and experience which is exist in our prior knowledge, and we know that this is not a recurring one. This doesn't have, like we can see it here, like there doesn't have a probability of once in many years or one in many operating years. So it certainly depends. So accordingly we have give them the high, medium and low based on their likelihood. And when we talk about the impact, in the impact, once we talk about it, in that case, like it is, if we consider it high impact, if have a like this performance quality cost, it will impact the performance quality impact, cost, safety in a major redesign, or it will delay our whole program. So in that case, it will be a high impact thing. For the medium impact, we'll take that. It's like a we can that doesn't impact our quality much, our performance and our cost much. But yes, redesign and schedule adjustments are required. We'll do it. So in that case, we categorize as a medium one. And in case like there is like no impact, or it's like a very minimum impact on the quality performance, we can say it as a low. It is considered as a planned, like planned, like which is a residual, or we can say it as it is was expected one. It is a normal loss. So in that case, we'll consider as a low impact. Okay, so this is the whole process by which we do the risk assessment and we give the risk rating to the all the risk once we have identified it. Coming to the next step, in which like you can see in this table, once we identify all the risk and we map those according to this, you can see like if in the red points, which is the high, most certain, and they have the likelihood is very high and the consequence is very high. In this criteria, like this is of extreme risk. For this, the company need to take an immediate action where senior management need to get involved and prioritize and take this on a very, very like immediate action is required by the management. When we talk about the orange bars, orange boxes, which is the our risk pointers, in this, management responsibility should be specified, but it is not like we need to take the action immediately, but it can impact us. So management responsibility should be fixed and it should be specified. Accordingly, this action can be taken. And when we see this dark green boxes, this is called the moderate risk, which is called the medium risk. In this, it can be managed by like we can define a specified person, which is we can define a SPOC for this. And in this person will be given the responsibility of taking care of this risk and managing this risk. Okay. Whenever we talk about this light green, which is like possible, there's a possibility, but there's an insignificant impact. In that case, it will be considered as a low risk, and it should be managed by a routine process. Of normal SOP will work, or with this, in this case, company can accept, like company can define it like they want to accept this risk and they don't want to take any action. Okay, so in this, like this is a scoring result which we get after like mapping those and getting the like whole structure ready and risk rating. Right. Once we identified and assess those risks, there can be various response plan which we have, which can be like there can be positive risk as well and can be negative risk as well. So for that, like we have already discussed in the identification part, where like we have categorized that into the four parts. Company take the once the assessment is done, whole assessment is done, and final decision has been made. Company can take that following action against the negative risk. First is they can avoid those risks and they can close down that activity, or they can like take a serious action and put a control around it. Then mitigate the risk is they can appoint an internal auditor, they can appoint a like concurrent auditor, they can try to mitigate that risk as soon as possible by bringing that like putting a robust system around it to control, like to verify and ensure that this risk is not impacting us, or like they are not occurring. In the third step, they will transfer this risk. Transfer of risk, I've already given the example of insurance company and the cash management system, and other examples are already there. So transfer, in this case, company decide to transfer this risk. They don't want to handle this risk internally, and they give it to like some of the third party to take care of it, and accordingly third party will take care, and the company is transferred, and company doesn't need to take care of the risk. Fourth is the company accept this risk. They are ready to accept it, and they say like it is a very nominal thing and doesn't have the like major impact on the company. So they will accept that risk, and but this risk need to be reevaluated from time to time, so that like whether there is a movement, because like this environment, like the whole control environment is so dynamic that it keeps on changing from like so it is always need to reassess all the risk which has been identified, and need to reassessment need to be done on periodic basis, and accordingly like action plan, response plan need to be decided. Okay, so we have already talked about the negative risk. Now when we talk about the positive risk, like in that case, company have any new opportunity which is come in, means like the demonetization. Demonetization was a like a positive risk for Paytm. So in that case, like they have accepted that risk, they have taken for various action which can be taken against that risk. So if it is a very nominal positive thing for a company, so that they will accept it and they will start working around it. If they don't have a relevant infrastructure, relevant thing to benefit from that risk, they will share it with the relevant person who have that relevant infrastructure, and they combinedly take the benefit. Companies see if it is very, very helpful and very important for the company to take the advantage of that, they enhance their capacity, and accordingly, they enhance their capacity infrastructure to take the maximum benefit about it, maximum benefit among about that risk. In case the company wants to exploit that, and it's like very, very good risk. Like again, in the case of the Paytm, they have started like in the second day in the morning, they have like full page advertisement on the first on the newspaper of the Times of India and major newspapers. They have, in that case, they were started exploiting that risk, and they taking the maximum out of from it. So they exploit that risk. So there can be a multiple response plan according to the risk rating, and whether it is positive or negative. Company need to decide. So all this process which we are talking about, the risk management, it is majorly around the company and the company mindset and the company approach towards any risk which they think is relevant for their company. There are various tools which company use for like their risk management. In this, like first tool is relating to risk and impact analysis. In this, like again, like which we have already discussed, company will identify all the risk and see their impact, how they're impacting the organization, what is the impact, what can maximum possible go wrong, or what is the minimum possibility, like what is the like they think what is the maximum thing which can happen, which is the maximum possibility of the impact of that risk that can be impacting the company. In the second tool, which is the practice which the in the risk management, they do the probability and the impact analysis. In this, they will identify the likelihood of the risk and how frequent, how fast this is going to impact the company. So in this, like they do the probability assessment. Then they define their risk mitigation strategies, and in this, we have already discussed here, which is their avoid, mitigate, transfer, or accept the risk. So this is their mitigation strategies. They do the qualitative analysis of the risk management of all the risk, which is whether what is the quality and how the this quality and of the like risk assessment procedure is we are taking care, and how this going to impact the company. And in the quantitative analysis, they do the how this company have a like in the numbers term, like they will try to quantify it, and in that case, like how this company the risk will impact, they have a financial impact on the company. So all these five tools, the company these are major tools and the practices which is uh, taken in the risk management. So so these are the five tools which they are people are using and for the risk management. Uh, we'll go through the risk impact and the probability analysis. So it is a combined one for the first part. Means like company can see whether it is low risk, which is impact is very low, and cost is again very low. In this, manageable by the exchange against the internal budget, means minor tweaking in the budget, company can take care of all this risk. So when we talk about the impact is low, but the cost is again a lower side, requires some additional infusion funding from the institution. Means like they in the existing budget, they need additional cost funds for managing this. In for medium impact, the company need to evaluate whether like requires sufficient additional funding from the institution. In case of high impact, requires significant reallocation of the institutional fund, which is majorly from the borrowing or like fundraising, which they do from the outside. And when we talk about very high, it will increase, threaten the viability of the project. So company will evaluate the like impact along with their parameter, which is first is the cost, which we have already discussed. And second is the time, and third is the quality. In the time part, like if the impact is very low, the company will like slight slippages with the initial target, they can tweak the their turnaround time for the project, and they can like for any of the activity they can adjust it, and they that's won't impact the company much because it's like minor 1 or 2% increase in the time. When we talk about the low, they need to readjust their milestone or publish target, but again it can be done without that management approval and without taking like involving much into the higher management. The this can be done for the various process owners at the lower level. When we talk about the medium risk, they can delay the effect. They can affect the key stakeholder, loss of confidence in the project, and loss of client like confidence can be there. So we need to take care of this risk, and accordingly, we need to analyze the probability of this risk. When we talk about the high, so in this, failure to meet a key deadline in relation to the academic year or a strategic plan. So this will like major timeline which we have fixed, which can be high, like say, when we talk about the construction project which is going on, this like NGT ban in Delhi, which because of the pollution, it again impacted it's going to be a high impact for them, and which can impact their key deadlines which they have for the project with the milestone which they have given to the company. So this is going to be major impact. Then very high risk is the like delay in jeopardy visibility viability of the project. In this, like we can say let's take an example of the Ukraine-Russia war, which is like any project which is going on in Ukraine because of this war. This is going to be highly impacted, and this viability and there will be significant delay in the projects, which can be there. Then in terms of the quality, if when the impact is very low, it can be quality, like slight reduction in the quality or scope or no overall impact. So it won't impact us. But when we talk about the low one, failure to include certain nice to have elements means like any of the list, like say if any if a product have a like additional feature, like that thing can be missing. But yes, overall the main essence of the product is there, so it can be a low risk or low impacting. When we talk about the media one, the significant element of the of scope for functionality will be unavailable, and this will impact the overall quality of the project. Then, when we talk about the high, it is failure to meet the needs of the large portion of the stakeholders or meet the like quality which is promised to our clients. So it is again will evaluate that impact. And when we talk about the very high risk, the project outcome efficient effectively unusable means like we have given like in a construction project, if we given a like building which is not like which is weathering from the first day, it's like we can see a visible crack, it's not a which is a very high impacting one. So accordingly, in this analysis, we do the risk impact and how this risk impact have how probability, and based on the various factor, which is the cost, time, and quality, we evaluate those. We do the analysis for this. So this is the whole risk management process, which can be seen here. First is we have discussed the identify the risk exposure, quantify the risk exposure, which is risk assessment and risk rating. Then, according to that risk rating, will company will respond whether to avoid that risk, whether to transfer that risk, then whether risk reduction is required or we accept that those risks. Based on this decision, company will monitor and report result, and then keep on learning and improve it. Like means like they're improvising and keep on updating this on a periodic basis. So this is the whole risk management process which we have, and it is a quite detailed one. Now we have a good knowledge about the what is the risk, which is the risk management process, and now like this whole risk management process is taken care by the company, and this like company involved few of the like external experts or internal external. They majorly do it from the internal team, and like they assess all their risk appetite and risk tolerance level and all the risk strategy which they have, and for this like they can take the external help as well. But yes, this risk management process will help us in other like in the practical world which is relating to the IFC and the internal audit, and in where we can see like when the company want to like risk reduction and to avoid this risk in these two scenarios, company can take our help, and where this like IFC and internal audit will play a major role. So next, coming to the next major area, which is important for our today's seminar, it will be first thing is the internal financial control and the internal control over financial reporting. So we need to identify, like we need to understand that like both the terms are different. The major like most of the professionals presently doesn't know the major difference between the IFC and the ICOFR, which is ICFR. doesn't know the difference much, but will write in this through this presentation, like will help you out in understanding this, the way it's a major and major like difference between both the projects, both the terms, and how this going to be, how the process there flows. So before we begin that, there is a word of caution, which is like for the IFC, one size doesn't fit at all. The extent of documentation of internal financial control depends on various factors, including but not limited to the nature and size of the organization, scale of operations, policies, and procedure in place, and delegation in place, and people involved. So for each organization, like IFC and IFCFR is different, and it doesn't like process can be same, but the same thing cannot be implemented in all the companies, and each company have its own nuances, and the company have their own risk factors, and their control environment is entirely different. So doesn't like process can be same, but it doesn't have the same like same parameter, same risk cannot be mapped to in each of the companies. Right. So introduction of the IFC and IFC ICOFR, ISCFR. In this, like first we'll understand what are the relevant provisions of the Companies Act. In this, like first we'll define like what do you understand is the internal financial control. So when we talk about the internal financial control, it has been defined in the Companies Act under Section 134(5), which means the policies and procedure adopted by the company for ensuring the orderly and efficient conduct of its business, safeguarding of asset, prevention and detection of fraud and errors, accuracy and completeness of the accounting records, the timely preparation of reliable and financial information. This is the like whole purpose for the internal financial control. Further, like some there are some key requirements as per the Companies Act, in which like various stakeholders need to comment on the internal financial controls. So auditor report need to comment on the education internal financial controls, their design and their operating effectiveness. In director responsibility statement, director need to state that they had laid down the adequate internal financial control, and such control are operating effectively. This is covered under section 134(5)(e). Independent directors shall satisfy themselves on the integrity of the financial information and the company, and the financial controls and the risk misstatement are robust and defendable. They are defensible. So, an independent director also need to comment on the internal financial control. Board or report should include the statement indicating the development and the implementation of risk management policy, including identification of risk element, which is defined by Section 134(3) in audit committee. Terms of reference include audit committee also need to include their into their reference. They need to evaluation of the internal financial control and risk management system is in place. So we can see like it's a vast role of the internal financial controls. Every like major stakeholders need to comment on this, whether it is auditor, directors, independent directors, board, audit committee. Everyone need to comment on this, but they have their roles different. Well, that we'll discuss in the next slides, and that will be helpful for you. When like so we have seen a term which is called fraud, which is defined in the Companies Act. It include any act of omission, concealment of fact, abuse of position, convenience with intent to injure the interest of the company, stakeholders, creators, and the other person. So it means like you can see there's some major in like major highlight on the intent. Like with the intent, if anything is done, it's a fraud. So it is defined in the Companies Act, which is very important to understand before we go for the internal, like understanding the internal financial control or IFC. So we have discussed the internal IFC part, but when we talk about the internal financial control, which is not defined in the Companies Act, but it is defined under the relevant provision of the ICI guidance note on ICFR and PCAOB standards. So internal financial control means a process designed to provide reasonable assurance regarding the reliability of the financial reporting and the preparation of the financial statement for external purpose in accordance with the generally accepted accounting principle. A company internal controls over the financial reporting include those policy and procedure that pertains to maintenance of the records in a reasonable, accurately and fair reflect the transaction and deposition of the assets of the company. Provide reasonable assurance that the transaction are recorded as necessary to permit the preparation of the financial statement in accordance with the generally accepted accounting principle, and the receipts and expenditures of the company are being made only according to the authorization of the management and directors of the company. Provide reasonable assurance regarding prevention or early detection of unauthorized transaction, use or deposition of the company's asset that could have a material effect on the financial statement. So, the definition of this term, internal financial control over the financial reporting, has been reproduced from Accounting Standard 5, and an internal audit control over financial is integrated with an audit of financial issued by the Company Accounting Oversight Board, which is PCOB, which is USA organized board, which define the ICFR process. So, from this, we'll try to understand what is the IFC process, what are the key component for the IFC process which need to be taken care. As per Section 34 of the Companies Act, means the policies procedure adopted by the company for ensuring orderly and efficient conduct of this business, means the operational part. Company have the proper SOPs and other they have the DOS SOPs in place, and the company are working around it. Secondly, company has is safeguarding its assets, meaning the fixed assets or any asset which is owned by the company from unauthorized use or disposal. Their companies have their controls around it, safeguarding of their assets. Secondly, there's a prevention and detection of frauds and errors. Means the company have robust system around prevention and detection of frauds and errors into the financial statements or overall in the organization. Then accuracy and the completeness of the accounting records. So it will ensure that the accounting and complete accuracy and the completeness of the accounting records are there. Further, the timely the so whatever the financials which we have prepared or the statement MIs which we have prepared, the timely provision of the reliable financial informations are there. So you can see there's a four major component which can be I when we talk about IFCFR, which is so it is IFC is a combination of ICFR plus operational control plus which is the fraud prevention. So if you can see from the top four perspective, five perspective of the IFC, when we talk about the orderly and efficient conduct of its business, which is the operational controls, which is covered here. Then safeguarding of asset, it is in the purview of the ICFR also. Prevention and detection of fraud is it is coming here. Then accuracy and completeness of the accounting records, which is coming, is again a part of IFC, and timely preparation of reliable financial information is again a part of IFC. So all three, which is orderly and efficient conduct of its which is first thing, which is safeguarding of its asset, accuracy and completeness of the accounting records, and timely preparation of the reliable financial information is a part of our internal financial control. And when we include the operational control and the fraud prevention controls, then it will complete the internal financial control. So there's a major difference, which is the major difference, which is IFCFR is a subset of IFC, which is including operational and the fraud prevention controls as well. So when we talk about the few example, realization of sale is correctly recording the financial recording of sales in our books is the part of the ICFR, which is internal control of financial reporting. Discount on the sale as per the company's policy is the operational control. When we talk about the fraud prevention, which is unauthorized entries and changes in the books of accounts or the price master, which is there in the company and controls which is defined to prevent this fraud is we don't allow any unauthorized transaction change in the books of accounts. So the price master any change in the unauthorized change in the price master is there, which is under the fraud prevention controls. So all three constitute IFC. As you can see, like we have discussed in the previous slide, ICFR can consider only three component, which is as per the section 143 of the Companies Act, the term ICFR is a process designed to provide reasonable assurance regarding the reliability of the financial reporting and the preparation of financial statement, maintenance of record, reasonable assurance of the transaction recorded, prevention or timely detection of unauthorized acquisition, use, or disposal of the company's asset. So it includes maintenance of the financial record, authorization of transaction in accordance with the general accepted accounting principle, safeguarding of the asset of the company. All three constitutes together as ICFR. And once we add operational controls and the fraud prevention controls, then it will conclude to be a IFC. So this is a major difference between the IFC and ICFR. So this is some legal regulatory requirement for IFC and ICFR in India. We have discussed like in section 134 of the Companies Act, in case of a listed company, director responsibility statement, director have laid down, need to state that they have laid down the IFC and the controls are adequate and operating effectively. This is applicable only on the public listed companies. So it doesn't applicable to any other company other than the public listed companies. Any unlisted public company or private companies, this section is not applicable, and IFC is applicable on the public listed company. Okay, so directors have the responsibility to comment on their controls are adequate and operating effectively. When we talk about the section 150 and 143, which is auditor report, which is relevant for many of us, as we are like some of us will be appointed as the statutory auditor in many of the companies. We need to comment. We should also need to state the company have adequate financial control with reference to the financial statement, and also comment on the operating effectiveness of such controls. So, as a part of our audit, when we plan for any of your audit on the companies which is on which this section 143 is applicable, we need to ensure that the RCM, which is the internal control framework, is in place, and all the RCMs has been defined and has been tested. So this need to be tested by your team to ensure that this effectiveness and design deficiency or if operating effectiveness is not there. And company controls are major control which help, which doesn't impact our financial or doesn't conclude to be a material misstatement, should not be there. So it is applicable to all the companies, with some exceptions are there. It can be applicable to private companies as well, or unlisted public companies as well. We'll discuss that in the next slides. Uh, so this is applicable on major of the companies. This director responsibility statement is applicable on the public listed companies. In section 177, which talks about the role of the audit committee to evaluate the IFC and risk management process. Audit committee may call for comments from the auditor about internal control system before submission to the board, and may also discuss any related issue with the statutory and internal auditor or the management. So audit committee can discuss with the internal auditor or the stat auditor of the company to evaluate the IFC and risk management system. So audit committee also appoint external parties where they get this IFC tested, as they need to they need to comment on this. They do get the management testing done, so that this audit committee or the board members can comment on the internal financial controls based on the report of the external consultant. So this need to be tested. So in the second, which is 143, the start auditor need to test while doing their audit in the start audit. But in section 177, the company management can get the assessment done internally, which is not very effective. But it is always advisable that they do it with the help of the external consultant. And in this, like they get the IFC management testing done, and they get the report done accordingly. They comment on the internal financial control. So this is IFC is applicable for audit committee. And so one more thing which I missed to highlight in section 143, which is start auditor only need to comment on the internal control over financial reporting. Means any control operational and the fraud detection control, don't need to comment on this. So they only need to comment on the control which is coming in purview of internal financial controls, financial reporting. Okay. Audit committee and the directors need to comment on both, which is the which whole organization like the ICFR with along with the like fraud related controls and the operational controls. Again, independent directors in Schedule 4, which talks about the role of the independent directors, must satisfy themselves on the integrity of the financial information, ensure that internal financial controls and risk management systems are robust and defensible. So this is again applicable on public, listed and unlisted companies. This is not applicable on the private company. So once as we can see from here, like made in the public listed company, all these four section is applicable, and they need to get the IFC or IFCFR testing. Once they get the IFC testing, they automatically get the ICFR testing done. So this is applicable on all the public limited companies. And in like in section 143, which can be only applicable on the private limited companies, can be private limited with some exceptions are there, which we'll discuss in the next slide. Yes. So I've tried to like formulate this whole like requirement of the IFC and ICFR through the like through a table, which you can see here. Firstly, like director responsibility statement as per section 134, which is applicability is IFC. This is only applicable on public listed company. It is not applicable on any of the public unlisted company. So director responsibility statement doesn't constitute that. Auditor report, as per section 143, ICFR is applicable. It can be applicable for listed, unlisted, unlisted public companies as well. Only if their paid up capital is more than 10 crores in the previous financial year. It talks only about the previous financial year, not during the year. Again, the turnover is less than it's more than 100 crores, and loan and borrowing in aggregate is more than 50 crores. So in that case, like the ICFR is applicable, and auditor need to comment on that. In the case of private limited companies as well, this is applicable where with the condition that this should not be a OPC, which is one person company or a small company. It should not be that, and their turnover should not be more than 50 crores, and their borrowing should not be more than 25 crores. So in that case, this auditor report is applicable, and if it's not there, it is not applicable. So it can be applicable for any type of the company. Then the audit committee IFC is applicable again with some condition, which is it is applicable on a listed company. And when we talk about the public unlisted companies, in that case, like it will be applicable in case they have that paid up share capital of more than 10 crores and turnover more than 100 crores, and borrowing and loan and borrowing more than 50 crores in previous financial year, any point during the previous financial year. Independent directors, again, it's applicable ICFR only. This is applicable again with the same condition of the audit committee and the audit which we have for the audit committee. Rule 85 also require companies to report on the like board of directors need to report on the ICFR. This is applicable not on the listed company. This can be applicable on the private limited companies or the unlisted public companies. In this case, this can be applicable on these companies, and in this case, this board of directors need to comment on the ICFR, and this is the applicability. One more thing, if a small company, the company has given an exemption like under section, like there was a notification dated 13th June 2017 where they are given the exemption. Only this exemption is only in terms of the auditor report, not any other exemption. So, in if it is applicable in other criteria, it fall in it will be applicable, but it is only for the auditors. So in this case, there's one more thing, which if a small company or a one-person company, or it is a turnover less than 50 crores, or a borrowing during the previous year 20 less than 25 crore, but they have failed to furnish their financial statement as required under section 137 of the Companies Act. This default will automatically hold them accountable for ICFR, and they need to implement this ICFR. So if any default or any delay on the filing of the financial statement under Section 137 of the Companies Act, or annual return under Section 92 of the Companies Act 2013 with the registrar, in that case, this IFC will be automatically applicable. Even if you are a one person or small company, or have less than turnover of 50 crores or borrowing of less than 25 crores. Right. There are some few common myths among the people on society that this IFC is not applicable, or this ICFI is not applicable on us. Some common myths are meeting the CARO requirements is sufficient. They don't need to have a separate internal control framework. Uh, CARO requirement doesn't fulfill that. We need to have a separate internal control framework if that applicability is applicable as per the Companies Act, the cases, the scenarios which we have identified in the previous slide. Company or many companies, I've seen that companies say that we already have SOP in place. So we don't need this RCM, or we don't need this IFC testing, we don't need this ICFR test, because we already have SOP in place. This is not correct. This is this is a myth. We need to clear to our clients, or we need to clear to our professionals sitting that SOP doesn't mean that company have a internal control framework. Company, like there's another which is company are automatic controls are automatically in place, hence there is no need to revisit them. Means this is majorly in the companies which is promoter driven, and is like we call it, say, a Lala company. In that case, the company, their promoters thinks that the company are the controls are automatic, that they are running the company from so long. There's no visit, or there is no requirement for visiting the IFC. It is there. There is a myth. There's a requirement also, and there's very element importance during because of the changing and dynamic environment. There is no need to document the process and controls. So they say that we already have process, and we have already have controls around it, and we don't need to document it. We don't need a written framework. It is very much required. We need to prepare the RCMs. We need to prepare. We need to they define everything which is our risk controls and everything in that RCM, and this is need to be documented and need to be tested, and that documentation need to be there. There's no need to link the risk with the controls. The company say like we have controls. We like say we have put the maker checker control, but they don't have associated that with the risk. So this is important for any organization to have link the controls with the risk, and it's a common myth. Then process for ICOFA certification is not required. Certification is not required since no exceptions are noted by the auditor. Even if we don't no, don't get any exception, we don't find any design gap, or this doesn't found any gaps, in that case also the ICFR certification is required, and this need to be documented uh, to the compliance with the compliance of the Companies Act. Testing of control and remediation of the deficiency is the responsibility of the auditor, not the management. It is again a very big myth that the auditor is only responsible for testing the control and remediation of the deficiencies. It is not the responsibility of the management, but it is very important to know that all the there are 5 sections. Only one pertains to the auditor, which is section 143. Other than that, all these in section 134, 177, all that pertains to the management. So management is responsible, audit committee is responsible, board of director is responsible. Everyone need to take care of this. So this is the responsibility of all the board of directors, audit committees, and the promoters. There is no need for training and development of the employees. Uh, Once you have seen, because major company which doesn't have this framework, they don't their employees also not trained and developed according to this framework. So in this, we need to understand the training and development. Once we develop our RCM, we need to there is a very much requirement for a company to have the training and development of the employees, so that the controls are in place, and the risk which the company want to mitigate through that controls are properly addressed, and it's properly mitigated. Okay. Uh, so by this, like we'll take 2 minutes break. We'll come back and like we'll join back and take the session, carry forward the session. Hi everyone, I'm back. Hope like everyone able to understand. Like I'm very much clear to them, and we are not moving very fast on this. Uh, Coming to the next topic, which is like these are the common myths which we have in the internal control process, which is related to IFC. So now, like some definitions are there relating to internal control, which is we have some standard of auditing, which is SA T15, which help in identifying assessing the risk of material misstatement through understanding the entity and its environment. So it defined the internal control, the process designed, implemented, and maintained by those changed, by those charged with governance, management, and other personnel to provide reasonable assurance about the achievement of entity objective with related regards to reliability of financial statement, effectiveness, and efficiency of the operation, safeguarding asset, and compliance with applicability of law and regulations. So, this is the definition which is for the internal control. SA 315 also explains the five component of internal control, which is the control environment, company risk assessment process, control activity, information system and communication, and monitoring of control. So, you can note that this is same as which is given in the COSO framework. So, our SA 315 is aligned with the COSO framework, and this COSO framework, and this is like COSO framework is the most widely accepted. Say 315 is also aligned with the COSO framework, and accordingly, like help in addressing the issues. Some key definition which is used in like it will be used in our next slide. So before that, like we'll help you understand those. So one is the entity level, which is the highest level within the organization that dictates the control and sometimes referred to as control unit. It is at the level of that COSO entity level assessment is conducted. Then comes the process or activity level, which is the operation level, which is the actual activities are happening. Entry level is done from the management, and it's like the guidelines and which information flows from there. But actual execution, which is happening at the process level. Risk, which can could go wrong in a process, is a risk. Fine, you will see that RCM will include some assertion, which is financial reporting objectives. Like with there are various objectives to the various controls. So that is called assertions. Then we talk about the key controls. Key controls are those controls which is more the controls in which most reliance is placed with respect to mitigating the risk, which is very high, and key controls are there. that if that control fails, the whole organization can impact, and there can be a risk of material misstatement, which can be there. So there, like I've told you that there are many internal control frameworks which is there. One is the COSO, which is which is defined by the Committee of Sponsoring Organization or the Trendway Commission. Internal control framework, which is defined, which is COSO. Second is COCO, which is defined by the Canadian Institute of Chartered Accountants, which is called Criteria of Control Framework. One is COBIT, which is around the information and related technology, which is governing the which is majorly framework in an organization. Third one is the framework vision for standardization, which is we talk about ISO 31000. It talks about the standardization of the organization and its framework. One more is there, which is relating to Financial Reporting Council of UK, which has defined guidance on risk management, internal control, and related financial business reporting. But yes, most widely accepted framework is COSO, and which is accepted by which is integrated to our SA 315, which also talk about the same framework, and it is accepted. So we'll talk about this framework in the coming, yes, in this slide. Yes. So in this COSO framework, involve five processes, which is you can see this cube. In this cube, you can see there are five elements to the COSO framework, which is control environment, risk assessment, control activity, information and communication, monitoring activities. And it take care with the objective of taking care of the operations, operating, reporting, and compliances. And it take care of various, you can see various organization level, which is entity level, division, operating unit, and functions. So you can also clearly see from this framework as well, IFC and ICFR demarcation. When we talk about ICFR, it only take care of the reporting and the compliance part. In all the five processes, which is whole organization, they take care, and considering all the five elements of the COSO framework. And when we talk about the IFC, it take care of operation as well. So it is again ICFR is equal to fraud plus equal to operational control is equal to IFC. So this is the COSO for internal control framework, which have five major activities need to be taken care. First thing is the control environment, which involve demonstrates commitment to integrity and ethical value, exercise oversight responsibility, establishes structure and authority and responsibility, demonstrate commitment to competence, and enforce accountability. So this is the control environment which the management create, and this is the push from the management which we get. So this is the environment which is there, which is very much important for any framework to work upon. Based on this environment, we do the risk assessment, assess the suitable objective, what are the suitable objective of the company, then assess and analyze the risk, what are the risk of fraud, assess the fraud risk if there is any, identify and analyze the significant changes in the risk and which can impact the organization with major changes which can be there. So this is the part of risk assessment. Then when we talk about the control activity, we select and develop a control activity around that risk, and then select and develop the general control over the technologies, which is IT, deploy through policy and procedure, which is defined by the management, uh, by the management to cater to the risk which is identified. Then when we talk about the information and communication part, use relevant information. So whatever the information which is there from the risk and the control which we have, we use that information and process it, and we communicate it internally and externally, so that this risk can be risk and controls can be made aware to all the process owners, stakeholders of the various like a whole company, whether it can be internal or external. They need to be communicated to them. Accordingly, this process will work. Then the final step is the monitoring active. Once everything has been implemented, has been communicated, we need to monitor it on ongoing basis, and we need to have a separate evaluation and evaluate the deficiencies if there is any into the whole process. So this COSO framework help us sets the various parameters for our evaluation of an organization. So this is a widely accepted, most common framework which is used by in the across the world for the IFC. So whether you go to any country, it will be majorly a constant. Right. Uh, COSO framework also help ask us to define our objectives. So our objective can be operational objective. What are the final objective which we want to achieve from this whole risk management or risk control framework which we are defining? What is the objective which we have? So it can be operation, can be reporting objective, and it can be a compliance objective. So we need to first need to define the objectives, then we need to assess the risk, and then we need to have a evaluate the controls around it. So when we talk about the objective, it can be a growth. A company is not able to grow its revenue, increase its market share. So company have objective to increase their revenue or increase their market share. Then they want to go. They want to go into new geography or new expand to the new profitable geography or region. They need to want to implement a new ERP system which can give them they can provide them accurate financial reports which can be there. Then company want to have objective financial reporting, which is there should not be any non-compliance there. They comply with all the accounting standards for the reporting. So this is the objective which the company have, and then final is the compliance, fraud, and compliance to ensure that the data protection leading to fraud and loss of intellectual property, anything which is impacting on it, is there, the company doesn't fall, and the company have the objective to to mitigate this all this fraud and to be properly compliant. So we need to identify define the objective for the CROSO framework. Then we need to assess the risk according to achieve that objective, and then we evaluate the controls which is around it. Yes. So this is the illustrative activity, various activities which is done in the IFC and SFR process. One first is the design. We design the key, we design in the designing process. So once you take any assignment for the IFC, ICFR, you need to first define the RCMs, which is there. So for defining the RCM, you need to identify the key processes which is there, then identify and map it to the various risk with the various items of the financial statement, then identify the financial and compliance risk to that process and map it. Perform a design assessment, identify the design gaps. So there can be two type of gaps in any of the organization. One can be a design gap, and second can be operating effectiveness. So design gap is something the process is not there. So company have a system in place but doesn't have a control around it. They are not defined, and there is a design failure on the company that this risk are there, but don't have a control around it. They have not defined it. But if the control is there, that risk is mitigated, and this assessment is done during our design phase. Then we document that risk and control. In this design phase, we have three output document. One is the risk control matrix, which is RCM, which is this is the base start from the RCM, which the major role which they play in the IFC process. Then we have the flowcharts and the design evaluation report, in which we did identify the design gap, the gaps which is there on the design level, that this controls the process are there, but the controls are not defined in that process to mitigate that risk. So we identify the design part. Then we test these controls. So in this, we prepare control testing sheets are prepared. We do the sampling. We control attributes for the testing. So for each control, there are some attributes which need to be tested. In this, like we define those. We do the exception reporting templates are prepared, meeting the process owners with the remediation plan. So this have the three outputs, like output document, which is created during this process, which is the control testing sheets. This is called the testing templates. Then we have control exception and failure report. Then the summary and the report for the management, which we give. Then final is the operating effectiveness. Once we identify the operating effectiveness not there, the workshop and training of the process owners is done. Risk and control assessment by the process owners on time, like periodic basis are taken care. Tests of operating effectiveness are done, and the remediation plans is finalized. So the final report is submitted with the control exception and failure, and report on the operating effectiveness. Uh, So this is the broad methodology which we normally use in the ICFR process, using the top-down and risk-based approach with address the requirement of ICFR and while maintaining the efficiency throughout the organization. So understanding the business, first we understand the business. What are the policies? What are the organization structure? What are the business processes? Delegation of authority, which is defined. What are the frameworks they have? Then we evaluate the control objective. What are the objectives which we have? We identify as is control, which is companies already following that control. Then we do some data analysis and test those control and give them the reporting improvement opportunities. So this is further, like you can see, this is further can be divided into phase one, which is design, then testing and operating effectiveness. This is the whole process, which is for the IFC. It can be tabulated before. There's a more practical approach, which is like first identify the significant account balances and disclosure items. Identify, understand the significant flow of transaction, how the information is flowing from various sources to into the system and how it recorded, and financial like finally it's by being the part of the financial statement. Then identify the risk of material misstatement in each of the process. Then we identify the control, identify the application associated IT controls around it. Then we do the design and implementation assessment, assess the design of controls, which assess the design of the controls which is implemented, assess the implementation, whether there has been properly implemented or not. Then appropriate design and implementation of controls are there. Further, like we assess the audit impact and plan other suitable process and plan operating effectiveness testing. Then in the operating effectiveness, plan nature and timing and extent of testing of the operating effectiveness. So in this we perform the testing, we assess the finding and conclude the effectiveness of the controls and form the opinion on the IFC part. In the report, we assess the impact on the audit opinion, which we need to give, which is whether it can be modified or any other adverse opinion, which can be given on the audit report on the financial statement. And this is the complete process of the IFC. This is a flow chart, which is easy to understand for how we'll do it, a more practical approach. Internal financial control, when we talk about internal controls, now there are three major components in an organization. One is the entity level control, second is process level control, and third is the IT control. Entity level control, when we talk about the corporate governance policies, procedures, companies have their ethical standards, culture, oversight. So accountability, they do it. So this is a part of the internal control, entity level controls. But when we talk about the process level control, all our activities, which is happening in the organization, which is procure to pay, order to cash, inventory, fixed asset, financial statement closure process, all this process are the process level controls, which is there, and all the execution part comes here. Then, because all the companies now is working in an environment in which the IT and technology play an important role. Along with that, there's a requirement for some IT controls as well, which can be like the application level controls, or it can be general, which can be internal control, or like ITGC, which we call it, generally accepted internal controls, which can be there. So we will learn some like entity level controls from in detail. So it is set from the tone is set from the top, provide excellence leverage to reducing the testing at the lower level. So it promote the integrity and ethical value, assign the authority and responsibility. When we talk about the entity level control, it can be like a company has prepared their policy and procedures and they've communicated to the various management. Company have an internal control process, which is it again a control internal entity level control. Company monitors their attrition ratio, which can be there. So these are the few examples which can be there in the entity level. So we can see this this is flow from the top, which is board of directors, audit committee, key management personals, auditors, company secretary. This flows from there. So the company whistleblower policies, their duplicate payment controls, code of conduct, background verification check. So these are the controls which is there from the top management. This is called the entity level controls. So these are some examples, which is company have the vision, mission statements, enterprise level, enterprise risk management process. Their company have they perform their board meetings periodically. Company have their disaster recovery plan or continuity plan. They have their code of conducts. Everything is different. So this is the entity level control. When we talk about the process level control, we need it's again a top-down approach, which is risk-based. This is financial statement. We identify the significant account, what can go wrong in that, what are the risk which is after like implementing the controls, there can be some residual risk which is there, and the transaction level controls, which is there. So, control designed to provide reasonable insurance. The process level controls are reasonable insurance. So we are providing that. And it is in accordance with the generally acceptance accounting principles. And it help in prevention and detection of unauthorized acquisition and use of the disposal of the asset, which cause material, which could materially impact the financial statement. So this process level control is done all at the execution level, and all our activity, all our business processes, which is whether it is procurement, whether it is sales, whether it is HR, all will process fall in this process level controls. So there are some few examples, like we have already told you, HR, procurement, sales, quality, inventory. So all these are the few example of end process level control, which is like formal agreements with the vendors. We have formal agreement where proper sign off, vendor evaluation processes there, a forecast or supply chain, like demand forecasting or supply chain process. So all these are the process level controls. When we talk about the IT controls, it is important to note that like we signify that how the information flow is relevant information flow is there into the IT system. So for that, we need to understand there are few type like there can be multiple technology and IT environment. You understand the IT environment. What are the technology relevant technology, or what are the ERP which we are using? What are the IT infrastructure which we have? What are the database? What are the operating system we are using? What are the network we have? So in this IT control, there can be, I've told you that like it can be a general IT controls, which is data center access security or system change controls, or when we talk about application, their company may be using many software, whether it can be tailor-made for the company or whether it is outsourced, like they have taken from the outside company or it is customized. So along with any application, there can be like multiple risk and requirement for controls around it, so that we because all the data, all the information is flowing through the system. So any impact, any change, any unauthorized access, which can impact the whole organization, like whole process, like whether entity level control or whether it is process level control is working fine. But if there is any lapse in the IT control, which can have a major impact. So this is a very important controls which need to be tested, which is ITGC. And ITGC is the part of like ICFR. And when we talk about IFC, it include all the application level controls, and we'll talk that in next slide. Uh, so you can see from here on that use typical where it include user access management, which is part of ICFR. Means user access management, like the person who's authorized to you give the access to the software, who are not authorized. We are once the employees is leaving the organization, we are closing their logins. So this is called access management. Change management is any changes into the software, any code, any change in the system can be a uh, authorized changes, and changes cannot be done without any without any authorization. Then there can be physical controls, environmental controls as well. Means organization have very big servers in place which they store in their data center, and it have many physical and environment controls as need for that. We give the restricted access to the server room to only the IT guys or the authorized person only. So, so there are many risks which is associated with the data center, because this can wholly impact the functioning of the organization. If any IT server is down, it will impact the whole organization. This is the part of the IFC. Uh, so backup and restoration is again is there. Then it is relating to IFC. Backup management, all the data is backed up like backup is done, and like there's a proper system for doing the backup, and so backup is very important, and in this IFC is play a role, and this control relating to IFC is taken care in this. Yes, so the backup in process access control is that. Right. So when we talk about the IFC, we need to do some of the we need to do the as a process, we need to do the process work. Primary objective is to understand the process material statement is there, can also be to test the design or implementation. And so one do through the process will identify the risk of any design level gaps is there. Like we're able to identify in the process like walkthrough itself. And it won't be like a testing is not much required to identify in the walkthrough process. So in while evaluation of controls through walkthrough, following a transaction from origin to the financial record. So what we'll do is we'll ask them what is how the transactions flowing from origin to the financial record,
Pratik sir,
how it
sorry
is
to interrupt.
recorded, the information is recorded at each level, and how it is impacted, and who's have the access to this information. Yeah,
I think your
yeah,
voice
yeah,
is
tell me.
breaking since last 1 minute.
Hello. Last 1 minute. Let me check my internet. Just a moment. Hope it is better now.
Yes.
I'm audible enough? Yeah, perfect. Right. So, in this while while evaluation the control, while evaluating the control through the walkthrough, first step will be we'll go through the whole transaction from origin to the financial record, how it is recorded, who is recording it, how what is the manual intervention, how the system is data is flowing from one system to another system, and so we need to understand the whole process. Then asking the probing question relating to the process. We'll ask the probing questions, or we'll take an interview type of thing with the process owner. Asking the related to control, we'll ask them, and we'll ask some questions related to the controls, and then we test the relevant test design of the relevant control. I mean, whether this control is properly designed, we'll identify that through the this process only, through the walkthrough. Finally, the operating effectiveness will re-perform this control. We'll check it, and we'll measure it on the various testing attributes which we have. Yes, so these are the various documents which is created during the IFC process, which is the process flowcharts, process narratives which you make. So it is the brief process narratives are brief like about the process as is process which is followed in the organization. It's not the recommended process, it is the as is process which is there in the organization. So map it. We need to map that as is process which is recorded into process narrative. Based on this, we need to create a risk control matrix which outline all the risk control associated and various processes. Then information produced by the entity in the IT application. So we need to what are the data and reports which are generated into the IT application, and further key spreadsheets or MIS or final reports are prepared. Uh, so we need to like for evaluation of the design effectiveness, assess. We need to assess the design of the in each control selected for testing. Consider the factor to evaluate the design of the controls and purpose of that. So for this, we need to understand what is the purpose of the control, level of aggregation and the predictability, how significant it is, how competent that person is when performing that control. Means like organization have a process of making a like they make have a process of making a payment. So if the payment is more than 10 lakh and like we need to test out on various parameters, we give that responsibility to any very junior accountant person to like check that and approve that payment. In that case, like that person is not competent enough or authorized enough to perform that control. So we need to evaluate those and we need to check effectiveness on based on this following parameters, which is dependency on the other control. Like if you have any dependency on the other controls or information, how frequently the information and consistency is found in this control, and it is how frequently this control is performed. So we need to like evaluate all the controls for their design effectiveness on this parameters, and these are the key considerations which you need to take care. So let's take some example of some case studies where we evaluate the design efficiency. So for the background, like there's an organization which there is a risk of material misstatement. So inappropriate payment to the vendors. There's a process for payment of the vendors. There's so company thinks it is inappropriate payment. There should be a relevant control, which is invoice are reviewed and authorized by a person of the business process owners and the payable manager based on the purchase order and receiving reports as applicable, and discrepancy are investigated and timely reported. Transaction level is like a company have more than 100 crores of transaction annually uh, for the payments, and company has defined a materiality of 10 lakh rupees, say. So here the company relevant control should be there, but the issue is control has not been implemented, resulting in missing controls and therefore design efficiency. So there is no so company have given authorization only to the like account payable person that you make the payment. So control is not there because in this process maker, which is the business process owner who is required to get the payment done, is the maker, and account payable person should be the checker. But in this, like the account payable person is only the person who is making the creating that payment and making the payment. So the control is not there. So this is a design level gap. So from this, we can conclude that as the control has not been implemented, all 100 crores of transaction could have been inappropriate payment, and there is a chance of material misstatement. So magnitude of the potential misstatement is very high because relevant control is not in place. So this is an example of design deficiency. When we talk about the same example in the operating effectiveness, considering all the background documents same, we see that controls is in place, but the thing is that we take a sample of 25. We have tested that in one sample. We found that the relevant approval is not there. We investigated that and we found that this is relating to the human error. So therefore, therefore cannot be concluded that if control is effective. But control. So from this, we can say that out of sample of 25, we have found that one case this control was not effective. It can be a human error or human error, but we cannot say it is a control is effective. So we can conclude from this that the control is not effective and is not operating effectively. Okay. And there, but we cannot state that it can be a material misstatement which can be there. But this control is there and it is operating not if operating effectively, but chances of material misstatement is very less. So for this, we can increase our sample size. We can see that we can see whether there's any redundant or other compensatory control around it, and accordingly we can push that. Uh, then, considering the same case study, we evaluate the operating effectiveness with respect to entity level compensatory controls. So, considering the all the background things they are intact, the control is implemented, but the control is not operating effectively. So in the last example, we have seen that there was out of one like 25 sample, there was one case where this control was missing and this was not approval. But the company have a quarterly review mechanism. In this scenario, company has a quarterly review mechanism, which is they perform the detailed review of all the payment or any changes, which is purchases which is made more than 3 lakh. Or they do the forensic audit of the account payable on annual basis, or purchase department review of the purchase of the history of the vendors on quarterly basis. So there are some compensatory controls around it for the effectiveness of the control. So from this, we can say that control is not effective, operating effectively, but we have a compensating control to evaluate that risk, and our risks are mitigated. In this, we can conclude that this is not a material weakness, and this control there's no risk of material misstatement in this. So, in this, the operating effectiveness of the company is there, and compensating controls are also there. So entity level compensating controls are there, and company have like robust system to identify and process the risk. When we call like once the our whole process is complete, ICSFR testing is done and everything. So following documentation is prepared at each level. So one is the account mapping. We do the trial balance and account mapping, which is created. We have business process cycle for the evaluation. We have process unit for the like we have the universe for the whole risk and the whole process. Then we create the RCMs and we can prepare the control evaluation templates in which we test the controls. We prepare the flow charts, and we have the testing templates for various process level and entity level controls. And final is our final report, which is prepared, reporting and mentoring, monitoring related document, which is prepared, which is the design gap assessment report, which is their summary or which we prepared and we gave a board presentation to the audit committee. So this is the whole document which is prepared at various level in ICFR process. By this, we can conclude the whole IFC and ICFR process. Just give you a brief around the internal audit before we jump upon the RCM and its benefit on their final rules in the internal IFC part. So internal audit is an independent objective assurance and consultancy activities and designed to add value and improve the organization operations. It is a continuous improvement. It's not a one-time event. Internal audit is a continuous process which keeps on adding value to the organization, which keeps on happening at a regular interval, periodic interval, which we define it's half yearly, yearly, or something. It is very important because in the current dynamic environment, the company now, the internal audit function has like totally changed. So it is moved from transaction based or traditional based, which is only based on the financial statement. Now it has been moved to the process part, which outlines the use for the like value creation for the company or process improvement and mitigation of the risk. So focusing on that. So majorly now the company or management which they want is they want their value creation to be done at max. Like their value creation should be there. to the company that doesn't want the fault finding activities to be done, and it is derived from the management, and it is objective of this is defined from the board of director audit committee, give the whole scope of work and finalize that, and based on that the whole the internal audit functions work. So we can see the various objective which is there, which is to verify the correctness and accuracy and authenticity of the financial statement accounting records, detection of the any fraud and prevention of that. Uh, so again, it again help us in commenting on the operating effectiveness of the company, and undertakes the like various special assignment which is forensics can be taken care. So there is a various the conditioning. There is a I have already highlighted that there is a continuous need for change in the like whole the like it is a there is a change in the like perspective for doing the auditing. Earlier, like it was in the traditional internal audit was the policing role type, means like fault finding or on the culprit, but now they are more focus is on the value creation and the process improvement, and like which can be measurable and which can be quantified nowadays. And now like companies have more focus on the other processes as well, not only the financial audits or the manual paperwork which is done in the previous or like in the traditional approach. In the modern approach, use of technology has tremendously increased. We are using various system which is called IDEA, or we are using the reporting mechanism tool which is called LARS. So these tools help us in identifying various deficiencies in the process. So now the things has moved from like transaction level to the risk-based approach. So earlier the auditing is around internal audits around the process part. Now it is more upon the risk-based approach. So this is the whole modern scenario which we talk about internal auditing. Uh, so this is the whole value chain creation of the organization. We see that we have the board leadership, business planning, market development, business development, practice strategy. All this blue part is done by the management. So here the internal audit doesn't play the role because we cannot ask him. We cannot go into the function of the management and teach them how to do the work. But yes, we our scope lies here, which is orange area, which is the operational area, which all the departments or other functions which you have, and their supporting function, which is their finance, insurance, HR, admin, IT. All these are the support functions. So this dotted box, is our purview of the internal audit. So we can see like risk based. So we have already highlighted like now the more approach is on the risk based internal audit, where we first identify the like or various risks which is there in the whole process, and then prioritize that risk accordingly, like prioritize the risk, and we focus on that area which has the various high risk, considering the other areas to be tested, but we need to be checked, but more priority on the high risk areas, then giving them the management with a concrete plan that to how they need to prioritize their risk and their focus on how which this need to be more which action plan need to be focused more like first, and come up with a defined action plan for the mitigation of the gaps, identifying the instruction of the management, and give a positive assurance to the audit committee on the functioning, operational, and the financial controls. So we can say that approach to internal audit is a real mix of the traditional orthodox internal approach and process-driven risk-based approach, focusing on evaluating the end-to-end process risk and evaluating the design, operating effectiveness under control, and using the sampling methodology. So this is the whole internal audit process which we have. In the first phase, we discuss the process owners, or if we have we have in like discussion and interview with the process owners. We identify the risk. We do the sampling, data analytics, which we do. Proposes the internal control with action, which actual action management action plan, which should be there, means like which is actionable thing, which should not be like which is practically possible. Give them that and give the final report along with the issues with the root cause and recommendation on that. So this is the whole internal audit process, which is a detailed one. I'm just skipping that. I'm just moving because of the paucity of the time. I'm moving to the last part of our like seminar, which is around the which is the most crucial part, which is the highlight, which is RCM. How RCM is beneficial for us, what is the role of the RCM, and how what is the benefit. in the internal control and IFC process. So when we talk the RCM, it is a powerful tool which can assist an organization identify. First thing is we identifying the risk, then ranking those risks and implementing the risk mitigation controls based on priorities. So prioritizing the risk. So risk assessment and mitigation strategy is the repository of the risk that poses a threat to the organization operation, as well as the controls in place to mitigate the risk. So we have various benefits of RCMs, which is providing a method for quantifying the size and the scope of the risk. So it helps us in identifying the where it is the size and the scope of the risk, which is very important for any organization to focus to decide their focus and prioritization of that. Then determine whether your strategies are appropriate for dealing with each type of risk. So we define the strategy or we define a control plan so whether it is appropriate or not, and accordingly take the action. Then prioritization, again, we have highlighted prioritization of the risk and make it simple to everyone to understand. So this RCM is created for each and every department separately, highlighting the roles and responsibilities, how the risk and the controls are going to work, how which financial statement, which financial situation is going to impact. Uh, right. So there are few various approaches for preparation of the risk control metrics. One is the process-based approach. In this approach, the company more focus is on the process. Means company have a process like procure to pay process. They define the RCM and they define their controls around it. So it is more focus allow the organization to link the financial accounts to controls via objective of the process. So means it is the more dependent on the objective of the process, like procure to payment process, which is procuring a material at a reasonable rate and finally making the final payment. So it is more on the objective of the process, unlike the risk-based approach, which is the more focus on the risk of the which is risk is there in the process and more focusing on that and defining the controls and giving the management more focused approach. In process based, you will see many controls.
Sorry to interrupt, Pratik sir. We
Yeah,
have
so
only 1 minute, to
yes,
conclude.
yes, I'm just concluding that.
Okay.
We'll conclude it next 2 minutes.
Sure, sure.
Right. So there's major difference between the process and the risk-based approach, but now which is more widely accepted as a risk-based approach, which we identify the risk in each process and then accordingly we define the control and take the whole process. So various consideration which we need to take care while preparing the risk control matrix. We prepare the complete inventory of the risk and controls, which is there. We identify those first listed down. Then we align with the process, and all the processes and all the procedures in the company have been mapped, and accordingly risk and controls are there. Then we perform a periodic review and of this RCMs, and we are periodically updated. Then we perform we do the testing, we do the proper documentation of this, and so this RCM should drive our test procedures. Uh, so this is the final thing, which is role of RCM in the internal audit. So in internal audit, help in identifying, assessing, and prioritizing the risks. Means when we prepare the RCM for any areas which need to be taken, we identify the areas and the risk which we need to identify, like we need to work on first, we need to check first. It help us in preparing a better scope. It help us in doing the proper planning of the audit, and then ensuring that proper documentation is there. So this is the role in the RCM. And when we talk about the IFC, it help in bridging the gap in the design level gaps, which is there, ensuring all the statutory compliances, which is relating to the company's act and SOX, which is there in the US. Then supporting evidence, effective and control monitoring every environment is there. So it help in supporting that, and it help us in continuous monitoring. Right. So this is all about the IFC, RCM and its role. Speaking about our firm, it is like giving a big about our firm, Kirtane Pandit, which is 60 over CA firm. We are 30 plus partners in this CA firm. We have 700 plus employees across India, and we have office in 7 states. and we work in more than 15 countries in India. So we are amongst the say like as with the SEBI ranking or the CAG ranking, we are among the top 10 CFO in India. So this is a brief profile which already highlighted by the Hiten. And thank you so much. Thanks everyone for being a patient listener and giving me the opportunity to present you the importance of RCMs.
Pratik
Right.
sir, we
Thanks,
have,
Archana.
yeah, in the interest of time, like we can take one question from Wasim. Like he is asking, can an internal auditor audit the business strategies or question the strategic decisions?
Normally it is not advice because like you have been appointed because this decision are taken from the manager because this is decided by the board of directors, which include all the which include all the independent directors or like various top management position. So it is not advised to question on the strategy, but yes, like if you have a proper backing and supporting document that this decision is not working well and you can like quantify those, you can present that because into your internal audit report so that like management don't feel offended because once you present that report into the board meeting, because your internal audit report is also presented in audit committee and board meeting, so it normally offends the board of directors until and unless you have proper evidence and you can see the like it was a fault of a one person, you can identify that. But if it's a fault of whole organization, it's not advisable in the interest of your because they have hired you. Yeah. So you can highlight it though them, but it's not advised.
Okay, thank you so much, Pratik sir. I would like to extend our heartfelt gratitude to our esteemed speaker, Sir Pratik Goel, for this enlightening session. Your insights into how the risk control matrix can enhance the effectiveness of internal audits and financial controls were truly invaluable. We appreciate the time and effort you have taken to prepare and deliver this presentation. Wow, your expertise and knowledge have undoubtedly enriched our understanding, and it will help us in our continuous efforts to improve our internal audit process and financial controls. I would also like to thank all our participants for their presence and for their questions. Uh, Once again, thank you for being here and for making this evening a wonderful. Have a good evening. Thank you.
Thank you. Thanks, Archana. Thank you, everyone. Have a great day.
Thank you.
Bye.